Okay, so let's start the webinar. Good afternoon and welcome to our inheritance tax webinar. This webinar will be in questions and answers format. We've been working with a number of clients recently on helping them reduce their inheritance tax burden, and this is mainly with tax planning. This seems to be an area where significant tax savings can be made. Our head of tax, David Bruton, will be answering all the questions. There's ask a questions option in the webinar below. I can see a couple of questions are in already. So please get your questions in early and we will do our best to answer them. A number of people asked their questions beforehand, so we'll start from that. A recording of the webinar will be sent to all attendees and will also be available on our website shortly after the webinar is completed. So let me first introduce David, who heads up our tax team. So David, say hello to everybody.
Hi everyone.
And what we'll do is we'll get straight into the questions. So the first one is an nice easy one for you, Dave. What is inheritance tax and what are the rates?
So I suppose it's known as capital acquisitions tax, and it covers any inheritances or gifts. So it's not only inheritances. The headline tax rate is 33%, so I suppose it's relatively high. But there are exemptions then based on the person's relationship to the person who's either giving the gift or passing the inheritance. So there are differing thresholds based on whether you're a child of the person or a close relative, or maybe not so close relative, or anyone else basically. So for a child, it can be it's up to 335,000. Close relative 32 odd thousand, and anyone else it's about 16 odd thousand.
Okay. And just on mentioning on the child, do you have to be mentioned in the will to avail? So if you're a child and you're not mentioned in the will, do you still avail of the higher tax efficient or tax free allowance?
You do. So it's a lifetime limit for that person. So that this child, that is, so they can receive up to 335,000 from their parents combined throughout their life, gifts and inheritances. You tally up the total of the gift and inheritances and compare it to their lifetime limit to see whether there's a taxable amount or not.
Okay, so it's not essentially, it's not the parent, for want of it, doesn't have to die to be able to give the person the money.
No, and there's no stipulation that they're mentioned in a will or anything like that.
Okay, so that's why it's capital acquisition tax. It's not inheritance tax per se.
Yep.
Okay, very good. And when do you pay the inheritance tax? We keep calling it inheritance tax because that's what everybody else calls it. So that's the common vernacular. So when do you actually pay it, assuming you get some?
So it depends on the when the event happens. So normally, if you take, again, sticking with an inheritance, I suppose the normal sequence is that the person passes away, and then at a later point that you've got your grant of probate or grant of administration, and it's the grant of probate or grant of administration would be the date that would stipulate when you pay the tax. So if that date falls in the period 1 January to 31 August, you pay your tax by 31 October that year. If that date falls in the period 1 September to 31 December, you pay by 31 October of the following year.
Okay, very good. And just on items that can be inherited, it's assets, it's all assets. And like if it's jewellery, things that are difficult, like a house, there's a price for it. For a car, there's a price for it. But if a ring, say, was worth 50 or 10,000 euros on the market, but someone was only willing to pay 5,000 euros for it, how does that valuation come into things?
So I suppose the standard position would be that it's the market value of the asset. So I suppose, as you mentioned, the ones that can be a little bit harder to value is if you've a piece of artwork or a watch or jewellery or something like that that's maybe a little bit subjective. It's market value. So I suppose in the first instance, it's a self-assessment tax. So you decide the figure that you put on the asset, and then decide whether it's necessary to file a tax return or pay any tax or not, or whether you're under your thresholds. if you wanted to be certain, I suppose what you would be doing is maybe talking to someone in that business. If you know, a jeweler, what would they pay for the ring in question, or the piece of jewellery in question, or a gallery, what would they pay for the piece of artwork, that sort of thing. But it's not an absolute requirement that you have a valuation, but it is up to you to kind of get the valuation pretty much right. I suppose items like that are always a little bit subjective. It can be, you know, you talk to two different people, they could put two different values on a painting or a watch or something like that. But that would be the general rule of thumb, whatever the market value is. And if you want to know that, I suppose if you don't know, you probably need to be speaking to someone in the business who deals with those assets.
And will tax authorities, like will revenue be looking for that sort of documentation if they felt there was a significant body of art or jewellery or watches or whatever it might be?
I would think only if they had a reason to question the value put on something. You know, I suppose if someone had I don't know, Monet or something sitting on their wall at home, and they put quite a low value on it, they could look to have it valued, and they could challenge you on the value of it. Then I suppose you know, if revenue were to challenge the value of an asset and they thought that you had significantly undervalued the asset, they can levy a fairly hefty surcharge on because of the undervaluation. So I mean, that can get very significant very quickly. You could be looking at what you'd be paying in tax again, almost, if you'd a significant undervaluation. But I would think if you had, again, if you take the example of a piece of artwork, if you had a valuation from a reputable firm in that business, you know, I'd be surprised if revenue went to challenge it, even though the value of assets those sorts of assets can be subjective.
And I suppose we're getting into it, if you inherited something, like there's a question here that says, can I just ignore inheritance tax? Which I think sounds like a terrific idea, but I promise I didn't ask that question myself. But if like revenue's position is always, if they see a piece of art on the wall, they'll say, right, where'd you get it? If you can't prove you didn't get it, then we'll just assume, you know, we're going to tax you on the value of it, sort of thing.
Yeah, I mean, pretty much all taxes in Ireland are self-assessment. So the idea is that you figure out your tax liability and you provide revenue with the details, and then they can decide to pick a sample of them to audit, or there may be something in the return that triggers, raises a flag, I suppose, in their system, and they go and look at it a little bit closer. That can be a full audit. It can be just a letter with a couple of brief questions to clarify something. So it's self-assessment. If you ignore it, I suppose there's a number of things revenue can do. One is that they can impose a penalty for not filing the return on time. Two, they can charge you interest on late payment of the taxes. And, you know, if you undervalue the return or an asset in the return, or file a false return, they can seek to prosecute you, and they can seek to prosecute you as well for not filing return. So I suppose they've quite an arsenal of measures that they can use to tackle people who either don't file returns, or who knowingly file an incorrect return, as opposed to just making a mistake in it. So it's, I suppose I'd be wary of, I obviously wouldn't advise anyone not to file a return, but I'd be wary of being too cavalier about it.
Okay, that's good. Just one from one of our international customers here, David. He's a British and Irish citizenship, UK domicile. Wife is French, Irish and French, but is Irish domicile. In the event of my wife passing, would there be an inheritance tax liability in Ireland on the passing of her assets to me? I have believed that there should not be. In my case, if I were to pass first, she would be subject to IHT in the UK on assets I paid to her. So this is husband and wife. So there's no inheritance tax on any of that, is there?
So I suppose when you're looking at whether inheritance tax might or might not apply, you're looking at three things. You're looking at, one, where is the asset situated? So if it's an Irish asset, that's always subject to inheritance tax here. where is the beneficiary tax resident, and where is the disowner, the person who's passing the gift or is leaving the inheritance, where are they tax resident? So if either of them are tax resident in Ireland, you have a potential for Irish inheritance tax to apply to the assets. If you take a person who's non-domiciled, they can't be considered tax resident for the purposes of gift inheritance tax until they've been tax resident for 5 consecutive years. So what we would see quite often is that where you've got an individual who's not domiciled here, they would look to maybe break their residency before they've been resident for 5 consecutive years. So if you've got a husband and wife and one of them is Irish domiciled, then you'd want to look at that closely, and there's maybe planning you can do around it. But you're pushing closer towards coming within the Irish inheritance tax net potentially.
And then there's no inheritance tax, correct, if it's between husband and wife or vice versa?
Correct. Yeah, exactly. So it would only be where the asset passes from one of those onto children or someone else.
And it doesn't matter where the assets are resident or anything. From an Irish perspective, the Irish tax authorities aren't concerned about whether your husband's assets are in the US or the UK or wherever they might be.
No. So as long as the individual is within the Irish CAT net, capital acquisitions tax net, it's your worldwide assets. So if you've got an individual who's Irish tax resident and they're in the net, CAT net as a result, you'd be looking at their entire estate potentially within Irish inheritance tax. Now, there can be relief for inheritance tax suffered elsewhere, so you wouldn't get a double charge to tax, but potentially would be taxable in Ireland.
So yes, David, I think there's no inheritance tax between your wife and I. Now, just be careful. This couldn't be considered official tax planning, so you might need tax planning usually comes with a document that's signed and on headed note paper. So, and God is in the detail when it comes to all sorts of tax planning. So we're more than happy to answer your question, but this is advice. This is not advisories in the truest sense. So okay, another international question from Carl. How is a non-resident who inherits shares in an Irish limited from a non-tax resident? I think, is that trying to decipher that a little bit? As a non-resident who inherits shares from an Irish limited. So if you're non-resident and you own an Irish company, and then your beneficiary is also non-resident, let's say they're both based in the US.
Yeah.
That US tax law, Irish tax law has nothing to do with that, does it? Or does it?
It would in that case, because shares in an Irish company would be considered an Irish situated asset. The reason being that the share register of an Irish company has to be located in Ireland. So the shares in that company would then be within the Irish CAT net. So you'd be looking at I suppose valuing the company and working out whether or not there was a tax liability potentially. Now, I suppose the one thing is, if you took someone who had a holding company above that Irish company and that holding company is located elsewhere, then you're not in the same position, because the inheritance would be of the shares in the holding company, which is located elsewhere.
Okay, so it keeps going up.
Yeah.
Till the ownership.
Yeah.
Okay, just another one too, back to domestic matters from Paul. If I live in my family home with my parents, do I still need to pay inheritance tax? Does it matter how long he lives there, or?
It does. So there's a relief or an exemption called a dwelling house exemption. And basically what it says is that the person who is, this is on an inheritance now as opposed to a gift, the person who's leaving the property must have lived there up to the date of death, unless now they went into nursing home care or something that wouldn't cause an issue. The person who's receiving the property as an inheritance, they must have lived in that property as their main residence for the 3 years up to the date of inheritance. And they can't have an interest in another residential property, whether it's a holiday home, apartment, house, anything like that. And if that person who's received the property as an inheritance is under 65, they must continue to live in the property for 6 years as their main residence. If you meet those criteria, the inheritance of that property would be exempt, so you don't need to factor it into inheritance tax. There is a further relief where it's a gift, but it's very restrictive. It's really where it's quite similar to the one for inheritance, but it's where the person who's receiving the gift, where they're permanently incapacitated, either mentally or physically, there can be circumstances where they would get the property exempt from CAT, but it's quite limited.
Okay, but that is a significant saving.
It would be, I suppose. I mean, if you take, if you're looking at a house in Ireland, I suppose it could be anywhere from realistically from kind of 200,000 to who knows what, But I mean, if you're looking at a more valuable house, if you took a house with a value of, let's say, 1.5 million, where there were other assets passing as well, and the person would use up their threshold, you've got a potential tax saving there of 500 odd thousand.
So you think that's why millennials are refusing to leave home? They're playing the long game.
Maybe.
That's the next webinar is about millennials and homeless and the homes issues. Yeah, we'll stay away from that one. And just on that kind of theme about how to reduce your tax liability, I suppose we'll get into a bit of that now on the planning side of things. Before we get it, one thing that's we've cropped up and people have asked us about is the Section 74 insurance policy. Yeah. So that's isn't that where you can get out? You can get an insurance against the cash you're going to have to pay on your inheritance.
Yeah, so it's basically, I suppose, a life assurance policy that pays out, but it's structured so that it's specifically to pay the inheritance tax liability. So the relief that applies to it is that the amount that's used to pay the inheritance tax isn't deemed an additional inheritance and taxable, but it's only the amount that covers the tax liabilities. So if you had a policy that paid out 200,000 and the inheritance tax liability was 150,000, the remaining 50,000 would be seen as an additional inheritance and taxable.
Okay, so there would be, I gotcha. Okay, so it doesn't cover everything, it only covers a certain amount.
Yeah, like, I mean, if you had a policy, let's say if you had a policy that was for 130,000 and that tax liability was 150,000, the full 130,000 is going to clear the tax liability, so none of it would be taxable.
Okay, and I again, like, so we're not insurance people, so it's difficult for us to be certain on it. But I think, like, the one thing that would be certain is that it's a pretty big policy. You're going to be tying up a lot of cash in this. Like, if you've the amount of money you're going to have to pay is probably the value of it's going to cover. Like, I think you have to be under 74. You could be 10 to 15. If the average age is 84 in Ireland, between two healthy parents, you could be paying premiums of 20 or 30 grand for 15 years.
Yeah.
And we're not certain on this, but I think isn't it possible that if you miss one of the payments, that the whole thing is invalidated and you lose all your previous payments? So it's like, it seems interesting. I think it would be very interesting for a kind of a single inheritor, isn't it? That if you're a family, if you're family with a number of children and grandchildren, you've got options. But if you're a single child inheriting a lot of property, then it's interesting.
It can. I mean, it can be useful. I mean, it's very much a case by case basis in terms of someone looking at it and seeing, one, can they afford it, and two, is, from a financial sense, does it make sense? But where it can be useful is if you have, the example you gave there, one child, say, inheriting from their parents, and they're maybe asset rich in terms of non-liquid assets. So if a significant property portfolio or something like that, and they didn't necessarily have a pool of cash to pay the tax liability when it came, that's where it can be useful. Or if you've done your tax planning and you've kind of maxed out your savings and you're still left with a significant tax bill, then, you know, I've seen people look at it in those circumstances in the past as well.
Okay, and speaking of tax planning then, so like if you take, we take some numbers, because you can run the numbers any way you want, but if you take numbers that you've got the average family size, maybe, so a family, you've got two, a couple in their mid to late 70s, they have 3 children who in turn have 2 kids each. So you're looking at 3 children, 6 grandchildren, 3, and say that, you know, all are still married. So 3 spouses. So they're all in people that can be, that's where the tax planning really kicks in, isn't it?
Yeah, I mean, the easy wins, I suppose, are the small gift exemption, which means that any one individual can give someone else 3,000 per annum as a gift, and it's not taxable. So if you take that scenario where you've got 2 parents and they've, what were we saying, 2 kids, 2 spouses, and
3 children with 2 kids each.
Yeah, so I'm losing count, but the parents can pass 3,000.
They one child that they didn't really like, but you know, they were stuck with them.
The parents in that case can pass 3,000. Each parent, that is, now can pass 3,000 to each one of those individuals annually. So it adds up very quickly. That, I mean, if you do that every year and you're disciplined about it, you pass a lot without it coming within the tax net when it comes to inheritance, because you don't have to factor any of that into your lifetime threshold.
And what's interesting too on that number, you might say, okay, well, you've got, and I know, like, you know, when I'm 75, I'm sure I'll be very concerned about keeping cash for when because I'll stop accumulating it. So I'll be very keen to hang on to it. But if you're looking at the insurance option, it's the same gig, really. You know, you're either paying the insurance premium for the Section 74, or you're paying the cash, and there's probably more savings in paying that gift allowance to each person.
Yeah, I mean, I think for a lot of people that would be the case. I mean, really, where the insurance policy comes in is not for people who are looking to pass assets like that, but where passing the assets through the small gift exemption won't make a dent. If you take someone who's got, you know, millions in assets, then really you're doing your tax planning, you're seeing how far you can go with that, you're seeing what your likely tax liability is, and then you're considering whether that insurance policy could be useful. But it's never a bad thing to just keep chipping away, you know, so that you're not leaving it there to come into the tax net.
Okay, and the mechanics is like, so I've run a spreadsheet here with that scenario where if you've got a couple and they've got a total assets of between cash and properties and everything else of 3 million. It sounds like a lot, but you know, with that generation and the price of property, it's not. It's a lot of money, but it's not that untypical. You'd be surprised, you know. Yeah. Like if they give the gift tax and they also spread the inheritance to the children and the grandchildren, they could save their beneficiaries about 175,000 euros in inheritance tax.
They could. I mean, what you'd be doing there is you'd be making use of the small gift exemption on an annual basis. And then what you'd be doing is you'd be making sure that instead of maybe just leaving everything to the immediate children, that you're leaving a certain amount to their spouse that's within a threshold that they qualify within, maybe leaving something to the grandkids that, again, is within their threshold. So
and that needs to be on their will as well, doesn't it?
That would, yeah, definitely. That would need to be stipulated on the will.
So if that wasn't stipulated on the will, then you couldn't do the tax activity to benefit from that subsequent to them passing.
No, you'd be purely looking at who's getting what in the will or what ways it's being divided up, and that's what you would be following in terms of working out the tax.
Okay, because it is a significant amount of money. And and if they're doing that on an annual basis, if and that's with the number, like with that number, they're essentially taking 36,000 euros, that couple, in their 70s are taking 36,000 euros and dispersing that to their children and their grandchildren, that's probably similar or a little bit less than what they'd be paying on the insurance premium as well. But if they're doing that, do they need to paper up on it? Do they need to put a one page together saying, here's our plan, this is why we're doing this, so if it is interrogated, it all stands up?
Yeah, I mean, I think it's never hard. It's never a bad idea to have this documented. I mean, I find a couple of, I can't remember what I was doing a couple of weeks ago, or the reason why, but you know, if you have it in paper, if anyone asks, well, why is that money going from here to there, and who's it going from and to, it's always useful to have some sort of a memo that outlines it.
Okay. All right, so we just have our final question. Yeah, back to the international stuff. So if I am a non-dom and I'm due an inheritance from the country that I'm tax or domiciled in, so he's a non-dom resident in Ireland, due an inheritance tax, do they pay inheritance tax in Ireland? How does that treated?
So if all of the assets are in the country in which they're domiciled in, and they haven't been tax resident here for 5 consecutive years, then that wouldn't come within the Irish CAT net. It would all stay outside of it. So really, when you're looking at a non-dom person and the assets aren't located in Ireland, now I'm assuming that the person leaving the inheritance wasn't Irish tax resident as well. I'm assuming that they're in the country.
So they're all American.
Yeah, exactly. So in that scenario, if the individual who's in Ireland, if they haven't been here for 5 tax resident here for 5 consecutive years, that inheritance in the US wouldn't come within the Irish tax net.
Okay, and if they were here for 5 years, it's irrelevant if they're non-dom or not?
Yeah, so what it says is that if you've been tax resident here for five consecutive years before you get the inheritance, then you're within the Irish CAT net. Now, Ireland has only 2 double tax agreements for gift inheritance tax. One is with the UK and one is with the US. So even though the Irish domestic legislation would say you're now within the Irish tax net for an inheritance here because you've been here for 5 consecutive years, you'd have to go and look at the double tax agreement and see, well, it might assign taxing rights to the US in that case, or US might have primary taxing rights and then Ireland has secondary taxing rights, but would have to allow a credit for the tax in the US.
So that makes it more interesting rather than like initially when you said that, I thought, okay, so that's the vast majority of people would be UK and US. That could actually be beneficial rather than the opposite.
Yeah, I mean, it could take you from, on the face of it, having a significant tax bill in Ireland to maybe not so much of a tax bill in Ireland when you look at it. It would very much depend on the circumstances.
Yes, the grey area that is tax. Terrific.
Yeah.
Okay. All right. So we've got all our questions. We're at about 30 minutes, which is pretty much the time we had budgeted for this. So I think we can wrap it there. I'd say thanks a million for your time again, Dave, and your insights. Always useful. Always good to get them. And thanks for all the people that turned up. Good turnout today. And again, we'll email the webinar and we will place it on the website as well. So that's everything from us. Have a good day.